Welcome to vTalkInsight, Allocator's Lens Daily for April 2nd, 2026. Global equities are snapping back hard, while bonds and commodities still flag growth and inflation worries. Middle East energy tensions remain the central driver, yet de-escalation hopes have unleashed short covering and renewed risk appetite. The issue now is whether this relief move can last. In equities, the dominant story is a sharp reset in risk appetite after one of the toughest months since 2020. Global indices have bounced hard, with the S&P 500 logging its strongest one-day gain since last spring, and the Nasdaq and chip stocks jumping even more as investors latch on to signs of potential de-escalation in the Gulf and a pullback in headline oil. That rebound comes after meaningful multiple compression rather than an earnings collapse. Forward price to earnings on the S&P has moved from the low 20s toward the high teens, even as aggregate profit forecasts edge higher, with expected growth now in the high teens for this year. Upgrades are concentrated in energy and in technology, where the so-called Magnificent Seven sit on their lowest relative valuations in years while still delivering robust cash flow. Under the surface, conditions are unusually friendly for active stock picking, with correlations low and the majority of constituents beating the index. Factor leadership is tilting towards strong balance sheets and positive earnings revisions, while AI remains a powerful engine. OpenAI's record capital raise and towering valuation, NVIDIA's investment in other chipmakers, and firm memory prices all underscore a broad infrastructure build-out that runs into industrials, materials, and utilities rather than just mega-cap tech. At the same time, fault lines are clear. Much of the latest rally reflects short covering after Iran-related headlines, so the move looks more technical than fundamental. Consumer-facing names, such as global sportswear brands, are cutting guidance as higher fuel costs and flat disposable income bite, and management teams may turn more cautious when they update outlooks this earnings season. With geopolitical risk still elevated and average stock drawdowns much deeper than index levels suggest, the equity tape is signaling selective optimism rather than an all-clear. The durability of this squeeze will hinge on the path of energy prices and what companies say about demand and margins over the next few weeks, before the story can broaden more decisively beyond today's relief rally. In rates, the signal is more cautious than the equity bounce implies. U.S. Treasury yields have fallen for several sessions, with the 10-year edging lower alongside a strong bid for European government bonds, including a notable drop in UK gilt yields. That pattern points to renewed demand for safety as investors shift focus from pure inflation fear toward downside growth risks and persistent geopolitical uncertainty. Bond markets are wrestling with two opposing forces: weaker real demand, softer hiring indicators, and simmering recession worries, with some estimates putting 12-month recession odds near 40%. Argue that longer-dated bonds could regain their role as a hedge if growth rolls over and energy-driven demand destruction takes hold. On the other side, structural concerns about rising fiscal deficits, heavy issuance, and still elevated inflation mean many allocators question whether current real yields on developed market sovereigns truly compensate for the risk, especially in Europe where term premia remain compressed. Policy adds another layer. The Federal Reserve and the Bank of England are signaling a pause, emphasizing two-sided risks and a high bar for additional hikes, while markets lean toward eventual rate cuts if inflation expectations stay anchored. At the same time, the prospect of larger fiscal responses to the energy shock, particularly in Europe, could push yields higher again by boosting borrowing and keeping inflation sticky. With bond volatility elevated and some investors choosing to stay on the sidelines, the next leg in rates is likely to be driven less by central bank speeches and more by incoming growth data and concrete developments around Gulf energy flows. Credit sits at the crossroads of these macro tensions. Despite sharp swings in rates and equities, corporate and sovereign spreads remain relatively tight compared with the volatility backdrop, leaving limited buffer if growth slows more abruptly. That matters because the energy shock is now hitting demand as well as prices, and supply chain disruptions are raising costs for industrial and transport-heavy borrowers. In emerging market debt, there is a clear differentiation. Hard currency bonds and commodity exporters, such as Mexico and Brazil, have become more appealing after yield spikes, and some investors remain constructive there, whereas local currency exposure has been trimmed back. Several emerging economies facing acute energy shortages are resorting to measures like rationing and shorter working hours, which can pull forward growth shocks and test weaker balance sheets. Central banks in those markets have been selling reserves, including treasuries and in some cases gold, to stabilize funding conditions and meet outflows. Private credit adds another layer of uncertainty. Large managers now face heightened scrutiny from policymakers over marketing, valuation, and governance practices, and conversations among allocators are increasingly about disruption risk in that space rather than classic bubble dynamics. With global merger activity surprisingly strong and AI-related capital spending booming, corporate risk appetite is far from dead, but any further rise in default headlines or gating events in private vehicles could quickly change how much credit risk portfolios are willing to shoulder. Foreign exchange and precious metals are reflecting the tug of war between safety and cyclical hope. The dollar has just come through a very strong stretch on the back of safe haven demand and relative U.S. growth, pressuring energy importing regions. More recently, there are signs the dollar is losing some momentum, which, combined with improving earnings expectations, offers a potential tailwind for non-U.S. equities, especially in Asia and Europe, if it persists. Policy divergence is also starting to matter again, with the Federal Reserve signaling patience while the Bank of England sounds more worried about growth than inflation, nudging front-end UK yields lower and weighing slightly on sterling. Questions about the long-term reserve status of the dollar, U.S. fiscal dynamics, and China's Treasury holdings are appearing more often in client discussions, even if they do not yet dominate pricing. Gold sits right at this intersection. Prices are pushing back toward previous highs as volatility and geopolitical risk rise, yet some emerging market central banks are reportedly selling gold to raise liquidity and support their currencies. That dual role, hedge and funding source, could cap upside even as demand for protection remains firm. Watching reserve data, central bank commentary, and any signs of strain in emerging currencies will be key for the FX and metals complex. Commodities, and oil in particular, remain the fulcrum for the whole macro regime. After one of its biggest monthly gains on record in March, as the Strait of Hormuz closed and Gulf exports were disrupted, Brent has now dropped back from the recent triple-digit peaks. Diplomatic efforts and hints of a time-limited U.S. military campaign against Iran have encouraged markets to reduce the probability of a prolonged supply interruption, and energy equities have underperformed as that risk premium has come off. Even so, the system is far from normal. Millions of barrels are stranded in the Persian Gulf, tanker routes are being delayed by weeks, and physical cargoes of crude and products are changing hands at much higher levels than headline benchmarks imply. Jet fuel in Europe is effectively trading at the equivalent of well over $200 a barrel. Inventories are tight into the summer season, and officials warn that shortages could emerge as soon as May if flows through key choke points are not restored. Analysts expect oil prices later this year to remain materially above pre-war levels because commercial inventories are depleted and producers and consumers alike now need a lasting security premium. The macro implications are stark. Persistent elevated energy costs raise the risk that today's soft landing hopes give way to something closer to stagflation, with global growth forecasts already being revised down and some specialists putting recession odds around 40%. Oil exporters outside the Gulf, from Norway to Canada and the U.S., are relative winners, but domestic consumers in those economies still feel the pain at the pump. The shift toward building larger strategic reserves and diversifying away from vulnerable supply routes is likely to support demand for hard assets, including certain metals and nuclear fuel, well beyond the current conflict. For cross-asset allocators, the path of Gulf energy flows remains the central variable in deciding whether today's relief rally in risk assets can coexist with a still fragile growth and inflation backdrop. Stepping back, the cross-asset picture lines up as follows. Equities are signaling renewed risk appetite, powered by AI-driven growth stories, earnings upgrades, and a powerful short squeeze linked to hopes of Middle East escalation. Rates and credit, by contrast, are more ambivalent, with government bond markets rotating from inflation fear toward growth anxiety and credit spreads still leaving limited insulation if recession risk rises further. FX and commodities tie it together. The dollar and gold continue to capture hedging flows, even as talk of a peak dollar and central bank gold sales complicate the usual playbook, while oil and refined products remain a key swing factor for both inflation and growth. For allocators, the main watch points now are concrete developments around Gulf energy flows, the tone of upcoming earnings guidance, and whether bond markets start to price the same recovery story that equities are embracing. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.